Welcome back. Asia is off to a strong start and the SGX Nifty is suggesting that our gains could be to the tune of about 80 points, at least to begin trade with. So gap-up opening is what we should prepare ourselves for. Chandan Taparia, the derivative analyst at Motilal Oswal Financial Services, is with us on the show. Chandan, are we approaching resistance levels, congestion levels, or would you buy into the up move in the morning?
Good morning, Rima. Thanks for having me. So market has surpassed the congestion zone, which was near to 17,777 marks. We have seen good momentum in both the indices. In this series, the Nifty is up by around 4.88% and open interest is down by around 34%, which clearly indicates that short covering was seen in the entire series. However, the rollover is 64%, which is lower than last month rollover of 74%, lower than its 3 months average of 74%. So it's lower than last month and last 3 month average. And the open interest is even the lowest in last 3 years since May 2020. So we are light in terms of market position and giving the breakout. So light market can extend the momentum further. So we believe that any small dip could be the buying opportunity with the support of 17,777. This rally can even extend to us 18,200 to 18,400. So we will continue to remain bullish with the stance of the positive momentum and further short covering. FI's long short ratio has improved to 41%. We believe that this ratio can even head to us 50%. Talking about Bank Nifty index, which outperformed the broader market, it rallied by around 7.7%. Open interest fell down significantly by around 50%, from 50 lakh open interest to near to 24 lakhs open interest shares. So this momentum could continue. We believe with support of 40 to 750, Bank Nifty has potential to head to us 43,500 level. Now talking about stock specific, first that is buy on Chola Finance. This stock has seen 97% rollover. We have seen huge surge in the price, long built up, and short covering also triggered the momentum, and now it is giving the breakout from its pole and flag pattern on the daily chart. So recommending to buy on Chola Fin with a stop loss of 840, and stock can head to us 888 to 900 level. Second trading idea, that is from the rate sensitive real estate counter, that is buy on the Godrej property. 93% rollover. Price is up by around 25-30% in the last series, with significant open interest addition of around 10 to 12% after the short covering. It surpasses falling supply trend line, and sector is also witnessing the momentum in the strength. So recommending to buy on Godrej property with a stop loss of 1300 and expecting it to head to us 1385. Last trade, that is from ITPEC, that is buy on Persistent. We have seen good recovery in the counter in last 2 trading session and good recovery in last 2 weeks. Negated is negative formation of lower top, lower bottom, and Nasdaq has recovered. So selective IT stocks will also see the positive momentum. So Persistent is one of the strongest counter. So recommending to buy with stop loss of 44.40, and stock can head towards 47.20 levels.
Okay, all right, Chandan. Wishing you a good day as well and a rocking weekend as well. Chandan, thanks so much for joining and filling us in with those cues. Well, let's focus on Laurus Laboratories. Well, they reported a rather disappointing set of numbers. It was a top-down miss, and the numbers came in yesterday. The stock did see some bit of selling. The margins came in at lows that we've seen in the last many quarters at around 20%. But to understand what's the view and how things move from here on, we're joined by Dr. Satya Narayan Chava, the founder and CEO at Laurus Labs. Hi, Dr. Chava. Good morning. Thanks so much for joining in. Well, you have spoken about FY24 as being the year of consolidation. What's the likelihood of you seeing a bit of a degrowth? Is there any possibility, or do you believe it'll be a flattish to a positive year in terms of revenues? And what about margins? Have they bottomed out at around 20 to 21%? Then what's the scope of improvement from here?
Good morning. The FY24 is going to be a consolidation year for us. What it means, we don't expect any degrowth. And the margins, what we declared in the Q4 FY23 were at 21%, was the lowest the last 3 years. Now, that was primarily because of severe price pressure in ARV, APIs, and formulations. The second, we have created huge capacity in APIs and formulations in anticipation of commencement of contract manufacturing of formulations to European customer, and also manufacturing of clinical phase products for big pharma. All those capacities had a lot of deleverage because of operating expenses. That was the main reason for a low EBITDA margins in Q4. We believe that was a bottomed out of the number for margins, and we expect margins will improve year onwards.
You had said that at the end of the third quarter, you had said that margins will be will improve in FY24. You said that full year margins will be 28% and FY24 margins will be an improvement on that. I mean, as you stand at the end of the fourth quarter, would you want to update that guidance?
We are not giving any guidance on our revenue or EBITDA numbers quantitative. We can only give you qualitative guidance. The reason for significant drop in our EBITDA numbers in Q4, as I explained, primarily led by disruptive pricing.
Dr. Chava, we got that. But since you already put out some sort of a guidance out there after the end of the third quarter, given what you have reported, could you give us a broad way to think about what margins, or maybe a band, what you see them in FY24?
See, currently, if you look at our FY23 margins were at 26%. And by the end of FY24, we expect margins will reach more closer to 25%. And we need one more year. To go back to our aspirational EBITDA of 30%. We will get that by FY25.
Okay, so at FY24, 25%, and FY25, you're saying aspiration is to by the end of FY25 to 30%.
30%.
Okay.
Okay, so in 2 years,
why we are saying we have a good visibility what we are doing and what product we are doing and to whom we are selling at what price. The uncertainties of FY23 of large order from Big Pharma is over. And we are commissioning a lot of capacities in a phased manner. Animal health revenues will kick in second half of this year. And several clinical phase programs will be supplied starting from Q2 onwards. So the confidence level on FY24 is very high right now.
You're saying by Q4 FY24, margins could go up to 25%.
You're right.
Okay, got that. So just if you could break up your top line guidance in terms of individual segments, what are you baking by way of growth in the CDMO synthesis or no growth in the API sales in ARV? Could you give us, when you arrived at your guidance figure for the full year on the top line, what are you expecting in the individual segments?
We expect our efforts towards stabilizing ARV, APIs and formulations will give benefit from Q2 onwards. We have taken process efficiency improvements as well as purchasing efficiency, manufacturing efficiency. All those will kick in Q2 onwards. So the margin pressure what we had experienced in Q3, Q4 and partly in Q1 will wane off in Q2 onwards. So the API business sales will improve, margins will improve, and the formulation sales in US and Canada will also improve margin. So the overall margins are driven by ARV APIs and other APIs. Those are seeing positive trends beginning of this Q1. And because of high base of CDMO last year, close to 2150 crores. So we expect some decline in synthesis sales, CDMO sales. But we are very bullish on that segment because we have signed many clinical phase programs in several big pharma, and those will we supply initial quantities in this financial year and maybe significant quantities in the
So what could be the expected decline in the synthesis CDMO sales in FY24?
It's not very significant, I want to tell you. We can't give a number, but it is not very significant.
So in single digits, mid-single digits?
Yeah, we'll give you the more guidance at a later date. Want to communicate, see, when we are saying it's a consolidation year, we don't actually get it of the total.
Right, Dr. Chave, to be quite careful about these guidance numbers, right? Last year you had a bit of a hiccup with regard to the $1 billion revenue, then 6,500, then it came in even lower. But we get it. This is a year of consolidation, so flat on the top line. But for FY25, you're saying you want margins to go back towards that 30% odd mark. What about for FY25? What kind of a growth can you see? You'll have 2 lull years. So for FY25, what kind of a growth do you think? 10 to 20%, 20 to 30%. You're talking about as is your mix changing. So margins we have, what kind of growth?
See, if you look at our EBITDA number, we did close to 600 crores, 1594 crores for FY. And that was at 26% EBITDA. So we expect the EBITDA numbers will be...
No, the EBITDA, Dr. Chava, EBITDA number we have, what kind of a growth will you look at for FY25?
I can say we'll see good growth. I can't give you any guidance right now.
Good will be 10 to 20 or 20 to 30. What can it be? Because you're going to give a year of flat revenues.
No, we have to take care of a section of people who ask absolute guidance and another section of people who want us not to give any guidance. So we will be very cautious in giving any guidance now. But our numbers should speak. So we can say we have more confidence on our business right now than last year. Last year we did grow from the previous year. It's not that we haven't any growth, but the year we have lot of confidence on many customers and many projects what we are handling right now. And we are ready to take opportunities because we added significant capacities in both API and formulations.
Dr. Chava, you said that on revenues, you will see growth, not a degrowth. At net earnings level, I mean, if you look at estimates from analysts who track your company, they're factoring in, a meaningful sort of degrowth, 24 over 23. What should we expect?
I don't want to comment on the analyst reports right now.
Okay.
So
right.
they're free to provide their views. Absolutely. I don't want to comment on those.
Very quickly, sir, what can you guide on the debt front?
See, if you look at the overall debt was a little less than 2,000 crores, we expect to maintain at similar levels. Despite of our huge capex, what we intend to do in FY24, we expect the similar debt levels.
What is the capex in FY24?
FY23 we did 990 crores, and FY24 we expect to do close to 900 crores capex.
All right, Dr. Chava, we'll leave it there. Thank you very much for your time, and we hope to speak with you again on some of the numbers that you've provided, and of course overall business as you expect it to start to pick up. I mean, it's going to be a back-ended recovery starting fourth quarter of 24 and then into 25, as Dr. Chava explained. Well, let's get back our technical experts. It's 4 minutes to go for the market open. The pre-open rates will also come up 35 points higher on the Nifty, 17,950 or so is where we're at. Mitesh was telling us that it's all going to be about individual stocks and would not like to take a big view on the index itself. Mitesh, 9-10 calls?
Yeah. Prashant, I'll go with a buy on BPCL to stop at 350 for targets of 367.
And, okay, fair enough. That's a BPCL for you, which is Mitesh's call right now. Now, let's just revisit Axis Bank and the numbers that they've reported with Abhishek. Abhishek, over to you.
Well, the analysts have loved the numbers of Axis Bank. They say that the bank has prioritized margins over loan growth. Q4 FY23 on a core basis is a strong result. They believe that there is scope for better growth ahead. The net interest income grew, which was aided largely by the fact that net interest margin also grew on a YY basis. So even though sequentially net interest margin has declined, better liquidity can help in lifting the growth going ahead. So asset quality remains robust and CET1 ratio is at 14%, which augurs well for the bank. They have raised profit estimates anywhere between 2 to 3% or even more, and they see scope for the a valuation re-rating for Axis Bank. Across brokerages, you are seeing target price ranging from as low as 940, which is of Macquarie, to as high as 1150, which is of Jefferies. Largely, brokerages have a target price of around 1100 for Axis Bank. Back to you.
Okay, got some pre-opening rates. Wipro starting off on the back foot. That's down close to about 2%. Sorry, Tech Mahindra is starting off on the back foot. That's down 2%. But Wipro is gaining. So despite a dismal Q1 guidance, the street likes the buyback announcement. And Wipro is currently up close to about 1.5%. And the other big one we were looking at is Axis Bank. Abhishek was telling us it's a solid quarter. Guidance is looking good. Axis Bank too is higher in pre-opening. Mitesh, any trades on technology names today? Wipro, Tech Mahindra, or on the mid-cap end, where we've seen some fireworks of late?
So actually, Wipro looks good to me. It gave a gap up on Monday, and then since then it's held that. So as long as it's above 370, good chance that the stock is heading towards 387, 390 zones, and then we take it further. And from the mid-cap side, Oracle Finance is something which I've been recommending, and I think that's gone into a very strong uptrend. Any declines to about 3,400, 3,420 levels will be welcome entry points. And once it clears 3,600, which was the first target, I'm looking at 3,780 as the potential target.
Okay, just waiting for the bell to ring and Friday's trade to open. The SGX Nifty is suggesting that it's going to be a strong start. Remember, Wall Street has closed with strength, gains of 1.5 to 2.5%. The Dow and the S&P 500 has their best session since the month of January. Asia started off pretty strong, so they've taken cues from Wall Street overnight. Currently, you've got a 1% rally nearly on the Taiwanese market, Chinese market. Hang Seng too has come off a tad bit from the highs, but still up close to about 0.5%. There goes the bell, and the first rate on the Nifty is at a level of 17,950. In the green by about 0.1, 0.2%, but not as robust as the SGX Nifty was suggesting. But nonetheless, continuing with the positive momentum from yesterday. Yesterday, we had a very strong second half of the trading session where the Nifty took out levels of 17,900. And this morning, we're trying to build on it, but not by a whole lot. In terms of the big gainers, Wipro is the top Nifty gainer. Wipro is currently up close to about 2%. It's followed it out with a couple of the other large cap IT names, TCS, Infosys, higher in trade. Remember, there is a rub-off impact from the 2.5% rally that we had on NASDAQ, and many of these IT companies had already corrected over the past fortnight after we got some disappointing earnings. So IT has started off pretty strong. UPL has been gaining in trade, so UPL is up. I can see green on the screen when it comes to SBI Life. Reliance Industries is batting for the bulls. Reliance Industries is up. And for the week itself, Reliance Industries has gained 1.7%. On the losing side, softness seen in HCL Technology. Tech Mahindra has also opened up absolutely flat. So there is no decline seen in Tech Mahindra. But HCL Tech goes ex-dividend, I think, by about 14 rupees. And that explains the fall on HCL Tech. HUL is under pressure for the second day in a row. So those are some of the big large cap movers. But outside of that, in the mid cap end, PI Industries is flying. On the losing side, Shriram Finance under pressure.
Yes. All right. Well, that's right, Rima. Let's focus on a couple of stocks. PI Industries, well, that's reacting very, very positively to this new acquisition. For the last 2 years or so, every time the management comes on, we ask them what they're going to do. They say they're looking at an acquisition. Finally, that's done. They'd raised money via QIP. So putting that cash in their books to good use. Stock up 7%. A couple of other stocks are seeing follow-through buying. Coforge, Indus Stars, LTTS, that's L&T Tech Services, all up between 2 to around 3%. Remember, this is the second day in the row that they're moving up. On the flip side, Voltas post disappointing set of numbers. The stock took a hard knock yesterday. They tried to clarify in the con call. The street is not having any of that. For the time being, the stock is down another 5%. Trent is reacting negatively, down close to around 4.5%. Godrej Consumer, they have gone ahead and bought Raymond's consumer business. Well, for Raymond, it is a pretty good deal. The problem is, bulk of that could already be in the price. So Raymond is actually lower with a cut of close to around 2% after running up 40% in the last 1 month or so. And for Godrej Consumer, the street is a little bit skeptical about how expensive this deal is. The business that they're acquiring is still single-digit margin business. Even if they can scale it to higher levels, still, in fact, there's a bit of uncertainty out there. So after seeing a cut of 2% yesterday, the street doesn't like it still, down close to around 2.5%. And ACC, the stock is a little bit lower. It's down close to around 1%. The margins were a bit of a miss, but for a large cement company with a capacity of close to around 40 million tons odd, it's trading at less than replacement value. So that's why, in fact, that stock as well has recovered a little bit from the low point of the day. So a flattish to mildly positive start is what we're seeing at the start of the May series. Prashant.
Nigel, it's once again turning out to be a market of stocks. I mean, it's not, there's a stock market index, and then there is stocks which do all the moving around. And this week has been absolutely about that. Even though the market and the Nifty itself has moved up, but it's been about these individual names. PI Industries, of course, is the top volume traded name. It's up a full 9% now. It's followed by a 2% pop on Wipro. RVNL, the railway stocks have been all the rage this week, 2% higher on RVNL as we start the day. Z was an absolute disappointment. I mean, all those stocks around the resolution at the NCLT, the stock fell from 220 to 180 kind of levels. It's coming up a little bit. Yesterday, I think, came up, and today it's up about another 3% or so. But generally, it's been a disappointment. Tejas Networks is up about 5%, 662 on Tejas Networks. Coforge is up about 2.5%. Emphasis is up 3%. KPIT, 2 days in a row, the stock's done well. It's up another 1.5%. So that's third day running. MRPL has got volumes. Right out of the gates, volumes are impressive. So, again, this kind of speaks to the kind of activity we have, the kind of interest we have in so many varied mid-cap, small-cap names here. And it's been true all of this week. So, Indus Tower, 2%. MRPL, 2%. Persistent, 2%. Syngene, 2.25% higher. Policy Bazaar, I think I saw a note from Citi. I think it was... we'll check, 3.5% higher, 600 on Policy Bazaar. Tanla Solutions, 3%, and not lacking volumes at all. All of these names, decent sized volumes for this point in the day, right at open. On the way down, I think Voltas saw a couple of downgrades after earnings. Voltas is down a full 4%. There is Shriram Finance, which is down almost 4.5% now. Raymond, we mentioned, 3.75% lower. Chennai Petro is down 3.75%. So MRPL is up, CPCL is lower. Bajaj Finserv is down about 2%, and Trent is down about 3.33% as well. Throw in SBI Cards as well. SBI Card is coming up with a 3%, near 3% cut, 762. And again, most of these names, actually all of these names have got decent sized volumes. VRL Logistics, if you can come up, that's coming up with a 7% knock, straight up. And not small volumes, but I mean, we'll wait for it to pick up. AI Engineering, 2.5% lower. Sanofi is down 6.5%. I mean, of course, it's not a big volume name any given day, but that's another one which I just want to quickly highlight. The Nifty is absolutely in the flat zone after starting about 30 points higher. And you got a 4-point change at 17,917 on the index at this point. So this is the market open with 5 minutes, not even 5 minutes behind us.
Some more stocks, in the broader markets. Aarti Surfactants has had a solid up move to begin trade with, and that's higher by close to about, I think it's a double-digit gain on Aarti, 15% higher. Strong numbers. Profits have gone up 96% for Aarti Surfactants, and that explains the 4.5% gain. Glenmark Life is another company which reported numbers, and the stock is higher by 5.5%. Revenues up 21%, a margin improvement of 500 basis points, and that's driving a 48% increase in the company's profitability. Radiant Cash Management, also I think the last time I checked, it had opened higher. That's up close to about 2.5%. Not numbers here, but in a block deal yesterday, you had BNP Paribas, buying about 10.5 lakh shares. And on the losing side, Apcotex is down 5%. Small company, but disappointing set of numbers with the profits down nearly 25%. So Apcotex is open. And by the way, the Nifty Bank is now in the red. Axis Bank is 1.5% down. So after opening flat, Nifty Bank in the red. And now Sensex too has given up. So pretty quiet. Not quite the cheer we thought the SGX Nifty was suggesting.
Absolutely. Gautam Trivedi is with us, co-founder and managing partner at Napian Capital. And Gautam, great to have you with us here on the program. Thanks very much. Quiet on the index, but it's such a rich market for activity if you look at stocks, right? And it can keep you so busy with earnings coming through and these large moves. And we've seen that all the last 4 or 5 trading sessions now. Your views and what are you seeing out there, Gautam?
No, I think you're absolutely right. It's very, very stock specific, sector specific as well. You've seen the private sector banks in particular that have had fantastic numbers. At the same time, you've seen IT companies that have, of course, disappointed. And we don't see any significant signs of improvement in the IT space, at least for the next couple of quarters, at least based on what we've been guided. So I think it is very interesting to see, different sectors performing wildly differently. Now, if you look at the last 12 months, and I think in some sense we've been in the twilight zone where the environment, is very, very dull to the extent that investors are now, losing patience and wondering what to do next, because a lot of them actually are telling me that, and again, these are colleagues and former colleagues and friends, that if a recession in the US were to happen, let's hope it starts next week and gets done with, versus having a slow death in terms of waiting for a more opportune moment to get into the market. So I think that's where the mood is. If you look at the equity markets in general, they've been so dull that the best performing asset class this year actually is Bitcoin, which is up 70%. And then the second highest is gold, which is only up 9%. So this tells you where things are. MSCI emerging markets, by the way, are up only 4%. So again, very, very dull period. And I think best to focus on individual stocks that you think have value going forward.
Hi, Gautam. Morning. So it looks like a perfect time then for a stock picker like y'all. Oh, what have you all picked up then? Since the markets is pretty much flattish, sideways moves is what we have seen. The Bitcoin surprised everyone when everyone was, throwing in the towel out there. But
That's
individual
right.
stocks, where have you all added some positions? Any new stocks you'll have picked up?
We haven't, I don't want to talk specifically on individual stocks, but the fact is, if you look at the BSE 500, the broader index, and the Nifty 50, I've always told people, is quite deceiving. You have to look at the broader market. And if you look at the BSE 500, there are about half the stocks which are down more than 20%. 135 stocks are down 30% or more. So, and if you look at names, I don't want to name individual stocks, but if you look at the EMS space, for example, those stocks are down as much as 40% from their peaks. A lot of the exporters are down 45 to 50%. Merchandise exporters. And again, I'm not necessarily saying the merchandise exporters are looking attractive, but I'm just saying there's value starting to emerge. A lot of names, a lot of sectors, and I guess I advise people to run screens, which will then, I guess, give them a sense of where value is emerging. But I think there is value starting to emerge. There's a lot of positive news that we believe will happen over the next, more in the second half of this fiscal year. So I think India, I don't want to use the word decouple, but India will, I think, perform better versus the rest of the emerging market in Asia Pacific Pac versus what it's done in the last 12 months.
So what are the positive triggers that you anticipate, particularly in the second half of the year? And if you could give some more color on where value is emerging right now.
Sure. I think on the positive triggers, what I would say is that, India today has the fourth highest earnings growth in 2024. I'm looking ahead, where consensus is now at about 13%. Korea is 44%, Taiwan's 19%, China's 14%. So we're the fourth highest and almost neck to neck with China in terms of earnings growth. Two, if you look at valuations, we've had about a 15% to 16% correction in a Nifty 50 valuation. Again, like I said, that is deceiving. That's really not what investors should be focusing on, because there's a whole swath of stocks below the Nifty 50 that are much cheaper and not as expensive as the Nifty 50 itself. The other thing I would add is the big capex program that we've heard in the budget, 13 lakh crores, which is a gigantic number. And I guess the government of India has realized that private sector capex may not necessarily again pick up this fiscal year. So the burden of spending still rests squarely on the shoulders of the government of India. Not to mention, you've got a major election next year, another 5 state elections to go. So I think a lot of that capex activity, both from the government and some of these state governments, will significantly pick up in the second half of this fiscal year. So I see these two things. I think the third thing, which a lot of people don't seem to realize, is that I think there is, to some extent, I think ONDC, again, it's early days, and I've been following this very much, we've been following it very closely. It's now expanded to 180 cities, 26,000 merchants, and 2.4 million products being offered. I think in some ways, this is where UPI was in its early days, and look at the way it's exploded. So I think this government seems to be pretty focused on expanding the ONDC network. That, I think, could be the third trigger. into going into the second half of this fiscal year.
Gautam, we're also entering election season, right? Especially state elections right now. Karnataka, of course, goes to polls on the 10th of May, results out 13th of May. Lots of activity there. Any thoughts at all? Is it relevant for markets at all, in your opinion?
I think to some extent it may be a one-day move on the markets, but I think once the results are out, and nobody knows which way they're going to go, but if let's assume for a minute if the BJP were not to gain power in Karnataka, and historically history's told us that's been difficult to do so in that state, I think the market will shrug it off, frankly, and pretty much focus on the economic health of the country, and that's really what's paramount at this point.
Okay, all right. Gautam, what about rural India? Still, it seems to be in a bit of pain. I think we had spoken about it the last time as well. But now you have these state elections that are coming up. Maybe rural India sees some bit of recovery. Maybe it's bottomed out. Do you believe it's bottomed out? And if yes, will you look to play a couple of themes out there?
It's a very good question. It's a very topical question. And clearly we're seeing a tale of two very different Indias. You have urban India where you've got, Nestle versus HUL. I think that's a great comparison. Blowout numbers from Nestle, 27% top line growth. In HUL, 4% volume growth. So, very, very mild numbers from HUL because that's more of a pan-India play versus Nestle, which is more of an urban play. In fact, I just got off the earnings call of Indian Hotels. And if you look at their numbers, again, very significant urban India play. And, numbers were absolutely stunning. Record profits. In fact, their profits of FY23 were higher than the combined profits of their three best financial years. So that tells you where urban India is versus rural India. But I still don't see signs and confidence of rural India picking up. You've got the monsoon starting in the next 2 months, and I guess we'll have a pretty good sense of where that's headed. So as much as there's been a lot of effort by this government in irrigation, we cannot forget the fact that India is still very much dependent on the monsoon. So if the monsoons are not good or unseasonal, or there's a bigger heat wave than anticipated, these are multitude of natural factors which can end up impacting agricultural growth, agricultural income, and as a result, spending in rural India. So I think I still am not confident that we're seeing signs of that picking up as yet.
Gautam, buying into some of these themes has been profitable. I mean, railways, for example, is one of those, right? You were talking about government capex, etc. Do you own any of these names, and where are these stocks set in terms of mapping out what stocks have done relative to the potential out there? One way to do it is to look at valuations.
Yeah, I think we've actually not invested in any of the railway companies, so not really an expert on that subject. Having said that, I think the best way to play the upcoming government capex is, I think, metals, is to look at cement stocks. I know there's been some degree of activity on the M&A side in cement, but I think these are the two best ways to play the upcoming government and state government capex.
Any particular stocks you would play from the cement space, Gautam? Because I'm looking at it and pricing is not really coming up, but the raw material cost is going down. What could happen is the large become larger, the small could be forced to sell. How do you approach the space? Stick to the large names or play the smaller ones which have valuation comfort, and maybe in fact there could be a potential takeover or a turnaround?
Yeah, I think that's a fair point. You're right, absolutely, that the larger cap companies, whether it's an Ultratech or the ACC Ambuja, or even for that matter, Shree Cement, they're more expensive than the smaller ones. And I still think there is merit in buying some of the mid-cap names, even if they are not necessarily takeover targets, just valuation comfort. Again, keeping in mind the fact that there still might be that US recession that, consensus estimates are still at 65% probability of that recession happening. So if that were to happen, and then we see that impact, the somewhat impact of that on the Indian equity markets, I think you'd be better protected owning some of the regional names versus the large caps.
Thank you very much, Gautam, for joining in this morning. Great conversation as always. We've got a corporate conversation waiting by. Ashok Leyland has secured a big order from VRL Logistics. This is to supply 1,560 trucks as the logistics major plans to expand and modernize its fleet by replacing old trucks. To discuss this order win and the demand trends going forward, we're now joined by Shenu Agarwal, the MD and CEO at Ashok Leyland. This 1,500 trucks order from VRL Logistics, when do you start executing this order, and any more fresh orders that you've bagged off late?
Yeah, this is a very prestigious order from VRL Logistics. We have been a long-time partner with this company, which is one of the largest fleet operators in the country. And this order will be executed throughout the year until March 2024.
Indication on how many more orders you're bidding for in FY24?
No. So see, our industry does not work like this. It is just that some of the fleet operators, they want to place annual orders. VRL is one of them, but most of them, they do month-on-month basis only.
Got that. How are the demand trends in the CV space now, and what could the growth for the industry look like next year?
Yeah, so as you know, in FY23, the industry was very, very upbeat, and we do hope that this momentum would continue in FY24 and beyond as well. All the macroeconomic factors are really placed very, very well right now. So I think this is a good time. I also think that this positive cycle will actually run a little bit longer this time because there has been a lot of thrust from the government. I think the pulse on the ground is very, very positive. I was in the market for the last few weeks, and there is a lot of positivity within the fleet operators as well.
Okay, got that. So Goldman Sachs put out a report saying that fast growth in the last 2 years could start to normalize as the sector has entered mid-cycle phase in the Indian CV space. Would you agree with that assessment?
Normalization in the sense that, in FY23 and the later half of FY22, we were operating at a very low base. So definitely we won't see that kind of growth that we have seen in FY23. So FY23, for example, MHCV industry grew by 40% plus, and Ashok Leyland has grown by 70% plus in its volumes. Yeah, so that kind of growth will not be there because now we are operating on a higher base. But definitely, like I said, all macroeconomic factors are positive. We will have a significant growth here in FY23 and FY24. And as I said, this cycle, I think, will be a longer positive cycle.
Okay. Sir, is there any room for margin expansion? And if yes, what would the levers be?
Oh, definitely. I mean, I am a big believer that this CV industry has to up its margin. Almost all the players in the industry are operating in mid to high single digits. This is not the place where CV industry needs to be. And I'm saying this only for a simple reason. That is, there is going to be a lot of changes in our industry in the years to come. And companies like us and others, they need to invest for this change to come. Right, and therefore it is very important that we generate more cash to be able to invest and lead this change. Our margin, definitely there is an upside, whether you see in terms of pricing opportunity, whether you see in terms of mix, or whether you see in terms of even compression of the cost. On all 3 or 4 fronts, there is ample opportunity to increase the margins.
So EV penetration, in your opinion, how will it shape up? Will Ashok Leyland, do you have, the levers to kind of be at the forefront of this in your segment?
Yeah, definitely. That is our intent. As you know, Ashok Leyland is a challenger in the CV space in India right now. And challengers normally love this kind of a change because that is the only time when they can hope to disrupt the pecking order. Right. So we are working very, very seriously and investing our money and resources in the alternate fuel space, not just EV, but also hydrogen, also CNG, LNG, and other fuels. So we are very aggressively working on that. We will definitely like to lead this change.
Just one final question, sir. Any plans to bring in a strategic player in the EV business?
Oh, we have already created a good structure, within Ashok Leyland ecosystem. We have a company called Switch, which is focused on electric as far as buses and light commercial vehicles are concerned. We also have a company called OHM in our ecosystem, which is focused on e-mobility systems. On the technology side, we are working with a lot of companies very closely to make sure that we mature this technology in the fastest possible time. Also on the market side, as you know, we have announced a few partnerships like with Reliance for the hydrogen ICE and for Adani and NTPC for fuel cell electric trucks. So yeah, we will continue to bring those partnerships on, and we are very, very open and willing to create more.
All right, Mr. Agarwal, thanks so much for stopping by and giving us your take on that recent order win as well as the path ahead for the company. Well, let's move on then. We're just chatting about the cement space, so let's get in a veteran then in the cement space, and he currently runs Sri Digvijay Cement. They posted a rather solid set of numbers. The company posted its highest ever volumes at 1.25 million tons in the past year. Margins improved as well on a year-on-year basis. It's one of the few companies to report that sort of an improvement. Mr. Anil Singhvi, the executive chairman of Sri Digvijay Cement, joins us on the show. Hi, Mr. Singhvi. It's been a while since we chatted, sir. Good to have you. Well, let's talk about a couple of numbers for the company specific first. You did 1.25 million tons last year. You're at optimum utilization levels. But have you done any kind of debottlenecking that we can see some volume growth from here? And also on the EBITDA front, well, as per your calculations, you're closer to around 1,200 rupees. We don't take the other income. But from here, can you stabilize at these EBITDA per ton levels? Is there scope for improvement? Give us a broad range.
Thank you for having me. First thing first, at 1.25 million, you asked me this question, whether we can do a little more. I've been saying this for the last couple of years for Digvijay particularly, that there is still scope for us to make this plant give us a better productivity. And I'm reasonably confident that without any further capex, what is the ongoing capex which is being done, I think we should be able to have 7 to 8% growth for 23-24 from the same plant.
All right. And EBITDA per ton?
Well, you talked about other income, but other income is essentially what are my cash on the balance sheet. So either I invest this back in the capex or I earn some interest on that. So I would take this as an operating income. So 1,200 rupees, what we earned in this quarter, I believe would be perhaps the best in the class. I don't think there's any cement company which will come closer to this number, because I've seen numbers of two other companies which are reported in last 2-3 days. Going forward, if the coal prices remain at what they are, or if they come down, because my expectation is that coal prices will come down, they will soften because oil prices already started softening. And as we go into the summer for the European market, I think the coal prices will soften further. So I'm reasonably hopeful that we should be able to do 11 to 1,200.
What about, Mr. Singhvi, good morning. There have been these reports quite a bit, and you're the best person to ask it because you don't mince words as well, that companies have been trying to take price increases, right? I mean, there have been 3-4 attempts, but they've not been able to sort of push it through into the market. What is the pricing scenario? And what's your own sense in terms of how it will pan out into the next 2 quarters?
I'm glad you asked this question because I think where industry has been struggling, that the fuel prices have gone through the roof. And in last 2 or 3 quarters, I was expecting that the prices will slightly move up to cover the cost for most of the players. As you would have seen in last 2-3 years, barring the last year, the EBITDA margins have been about 800 to 1,000 rupees, which have fallen down to about 500 to 700 rupees for most cement players. And that's largely on account of fuel prices going up. But I think it's been a bit of a volume game, if I may use that word, for last about 2 quarters. I think there have been some changes in the market dynamics. And because of that, the companies are pushing the volumes, but really not looking at whether they can recover the cost increases which have come in place. So maybe in a quarter or 2, I think again it will come back to recovering of the cost, because the EBITDA margins have taken a knock in last 3-4 quarters on that. So I expect that this volume game will be over in a quarter or 2 at best from now. And again, one has to look back onto the profitability. So I think sometimes it's a game of profit versus volume, and I think the volume game is being played out more than the profit game.
Mr. Singhvi, are you saying that, you said that you expect coal prices to come down, right?
Yes.
So
Yes.
a drop-off in costs will automatically lead to better profitability, or is it possible if they don't, because these are international commodities, industry will be able to push through higher pricing, or you think that will be tough to do?
I think if they don't do it, the industry doesn't do it in this quarter, the monsoon quarter will be difficult. So I think price increases you can expect only in October quarter, not before that. But before that, if the fuel prices come off, then somewhat profitability will improve. But otherwise, there will be a challenge for the next 2 quarters in terms of profitability, but volume gain.
So you see an attempt to increase prices in perhaps May and June. If it doesn't happen, then straight away in October post-monsoon, right?
Looks to me the scenario. I don't think there will be, because as of today, it doesn't appear to me that people are looking at increasing the prices. It's a volume game.
Okay. Got that. Can you tell us the total operating expenditure for you to increase your capacity to 3 million tons per annum? How much will it cost, and when is it expected to come on stream, sir?
We just got our environmental clearance. That's about a week back. It's on the drawing board stage. We will work on that, because that has been a question mark for Digvijay for a very long time, that when are we going to have the growth, because this plant will reach to some point in time a plateauing of the productivity. But we have squeezed out the best possible from this plant, maybe another 7-8% more growth this year. But next year, definitely, we would have to look for a growth coming in. So for that, we started working now. We just got a clearance. As I mentioned to you last time, that we have now limestone deposits. So I think it's another 2 or 3 quarters we'll be unfolding that plan.
But adequate limestone deposit is with you to scale up to this 3 million tons. At one point of time, I think before you all took over, that was an issue. But I think that's sorted right now. So you can scale to 3 million tons.
I would say that most things are sorted. And I want to put one point in here, is that perhaps when you look at on the other 3 parameters where the equities are really valued, which is your dividend yield, your ROE and ROC. And I'm happy to say that I don't think any company comes anywhere close to this.
Okay. All right. Well, if it's looking so good and you're a PE-run company as of now, post the takeover, any change of of promoter holding, or does the current company, I mean, that runs the company, the PE, the promoter, they want to continue? At some point of time, they'll want out, right?
I think that question can be best answered by the promoters.
But you haven't heard anything as of now?
I haven't heard anything. If I hear, I will let you know.
I hope so. What about, and you don't want to put a capex number, right? To go from this 1.5 million tons or to 3 million tons, it's still on the drawing board. You'll come back to us with further details.
Yeah, that's what I'm saying. Exactly.
Okay. Final question there. We have spoken in the last few months post the big Adani Group deal as well. And you said maybe not in the near future, but in the quarters to come, there could be some inorganic growth from somewhere. Anything have you picked up as of now? I mean, I hear about a couple of smaller plants in South. There's a lot of supply. On the West, you keep hearing about a couple of companies that could be on the block. Something you're picking up that you can share with us?
There is a bit of a lull on the M&A activity in cement industry, because I think most companies are right now looking at how they can increase their volume growth from the existing capacities. And you would see from bigger players that they were operating at around 70-75% of the capacity utilization until about 2 quarters back. And they've all pushed the volumes in last 2 quarters. So I think they want to squeeze out before they go for M&A activity. And profitability hasn't kept the pace. So I think it will be a challenge before they really go and acquire more assets, because at the end of the day, the debt will kill them. So unless the profitability improves, I don't think that there's going to be a big ticket M&A activity next at least 3 to 4 quarters. And largely the dampening on account of low profitability for last 2 quarters, and everyone is starting squeezing the cement plants to get a better productivity on that. So I think it's a dynamics which work on how you see the industry profile, how do you see where the valuations are, and then look at inorganic growth. So right now, people are, whatever capex which they have done, they're squeezing the best turn out of that capex.
All right. So it's a lull in deal making, and who better than Mr. Singhvi, who would know, consummate deal maker himself. Mr. Singhvi, thank you very much. Great to have you with us here. Appreciate you joining in with that perspective. It's always a pleasure. All right. We've got Thank you. We've got 6-point change on the Nifty, so it's absolutely flat right now. But look at the market breadth. If you can have the NSE advanced decline ratio up, it'll tell you the picture. It's such a rich market for stocks and individual stocks bouncing around, selling off. I mean, there is activity on both sides, but there you go. 2,000 stocks are higher and just under 700 stocks are lower. So the momentum is very much with the bulls and on the upside. We'll be joined on the other side by Umesh Revankar, Vice Chairman and Managing Director at Shriram Finance, to talk about their fourth quarter numbers. Later, we'll get into a conversation with Raymond CMD Gautam Singhania and CFO Amit Agarwal to talk about the deal with Godrej Consumer. Stay tuned.